Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Tuesday, January 21st, and I'm recording this from my office in Purchase, New York. In recent months, we've focused on the critical arguments for maximum portfolio diversification in 2025. We certainly recognize the dominant performance of the S&P 500 cap-weighted index versus most other global asset classes. But our job has never been about cheerleading the obvious, looking in the rearview mirror. Rather, it's been about risk management as stewards of long-term wealth preservation and accumulation. As such, we're constantly remarking our advice to the current and forward conditions. And now, as we rebalance for the new year and a new presidential administration, and as we also consider the recent stall in market momentum alongside a rapid rise in Treasury yields, we feel the need to reiterate our case for diversification. To summarize at the highest level, our argument basically has 5 points. First, the S&P 500 is both richly priced and excessively concentrated. The index currently trades at more than 22 times forward earnings. That makes it expensive both on an absolute basis compared to its own history and on a relative basis versus other assets like 10-year Treasury yields. What's more, with the 10 biggest names accounting for about 40% of the S&P 500, the index is overly dependent on a few key players continuing to surprise on ambitious forecasts. And in many cases, these mega-cap tech companies are actually competing with one another in key growth areas like generative AI and cloud computing. Second, earnings expectations appear quite optimistic. Current estimates put earnings growth at 13% in 2025 and 15% in 2026. The assumption that productivity and operating leverage can drive this growth seems a bit of a stretch, given that a potential slowdown is expected in economic growth. And it seems especially so when we consider that margin improvement has not been evident outside the Magnificent Seven. Their margins are already at all-time highs and may face a slowdown ahead. The other 493 stocks, if you will, meanwhile, may struggle to expand margins without job reductions and other cost cuts. Point number 3. Consider that relative value might be found in areas other than U.S. equities, which are expected to return only about 7% at the index level. From a regional perspective, the U.S. is extraordinarily expensive versus the rest of the world. There are also significant dispersions at the stock level when it comes to growth versus value, large versus small cap, and cyclical issues versus secular growers. This presents additional rebalancing opportunities. Meanwhile, credit and spread products supported by economic tailwinds could generate total returns approaching 8 to 10% if underlying rates ease just a bit. Fourth, there's the fact that stock and bond correlations have turned positive, a break in traditional patterns that historically has underpinned the classical 60-40 portfolio. Essentially, higher yields and thus lower bond prices are now coinciding with lower stock prices. This was the painful dynamic in 2022 when many investors experienced losses in both the stock and bond sleeves of their portfolios. A final reason to consider more diversification, however, is the uncertainty around fiscal policies. Our sense is this policy uncertainty continues to be underpriced. Growth-stimulating efforts around deregulation and tax cuts could be met with headwinds that may come from tariffs or immigration restrictions. Fiscal policy will likely unwind the dominance of the Magnificent Seven as benefits accrue away from the non-manufacturing asset-light group and toward domestic manufacturers, highly regulated industries, and smaller businesses. So yes, it's understandable for investors to want to stick with their outperformers, especially considering that the U.S. economic foundation is in many ways preeminent and currently in good shape. However, our concern is about investors looking to capture that strength exclusively through ownership of the passive index. Given the dynamics we've talked about, we prefer instead to diversify, finding opportunity amid valuation dispersion while seeking better risk-adjusted returns with underpriced catalysts. With that all in mind, we recommend considering supplementing U.S. stocks and bonds with non-U.S. equities like those in Japan, emerging markets, maybe European global brands. Also consider credit and spread products, master limited partnerships in the energy infrastructure space, residential REITs, select hedge fund strategies, preferreds, high dividend paying stocks, and even emerging market local debt. Thanks for listening. For more information on portfolio strategies and financial planning, as always, please reach out to your Morgan Stanley financial advisor.